Now, you have heard AI mentioned much on this stage today, but now it takes center stage. If the eye-popping valuations of artificial intelligence companies haven't caught your attention, I'm sure the fact that your staff are applying them to your strategies, perhaps willy-nilly, has got your attention. And so we really need to take a close look at this sector and how it is transforming our businesses. We've got the best people to do it on stage this morning. Samson Wong is going to be leading our panel. He is the Chief Investment Officer for Private Markets with the Exchange Fund Investment Office of the HKMA. Joining him up on stage is Richard Liu. Richard is the founding partner with 5Y Capital. We have Deven Parekh, who is the managing director at Insight Partners. And finally, David Siegel, co-founder and co-chairman for 2 Sigma, is going to be joining us here on stage. So with that, we're ready to talk AI. Samson, please take it away.
Well, thanks everyone for joining the Real AI panel today. Artificial intelligence has firmly cemented itself as the defining megatrend for investors. We are seeing its staggering potential unfold this year with agentic AI automating workflow, generative video becoming mainstream, and robots achieving unprecedented dexterity. The opportunities are vast. Fear of missing out and you only live once are terms that we keep hearing. But I think most of us would agree that the risks are also significant, from inflated valuations to implementation challenges. That's the core of our discussions today, and we are fortunate to have 3 very distinguished panelists. In the first half of our discussion, we will focus on talking about AI from an investment perspective. Then we'll zoom out to talk about the bigger picture and the future of AI. And I would say that I have been through a lot of panels before. We probably have the most interesting pre-panel meeting in the room before this. And I have encouraged my panelists, just don't be shy in front of cameras. So we'll see. So let's begin with probably one of the most difficult questions, and we'll start with David. AI and quantum computing are making inroads across industries, including investment. For instance, the recent HSBC-IBM collaboration used quantum computing to improve bond trade predictions. David, from your perspective, how can these technologies drive real-world investment outcomes today? And what transformation shift do you foresee if they become mainstream?
Well, I'd like to start by saying that AI is a very general term. And it refers to not just ChatGPT kind of large language models, but to various forms of machine learning and even systems that rely on technology that's 30 years old. And so for people to say that AI is only now being applied to, for example, investment management, I kind of laugh at that a bit because I've been basically doing that my whole life. The use of data and algorithms to make better decisions is nothing new. And there are a variety of AI methods, including large language models, but not limited to large language models, that are really good for making predictions. And investing is often about making predictions. So the technology for making predictions keeps getting better, and the data available for making predictions keeps getting better. And so it's very likely that this trend that algorithms will be used to make more and more important investment decisions will just continue. It's a different question to talk about, for example, quantum and how that's going to be used. Advances in quantum are quite significant, but that's really, in my opinion, not around the corner. I mean, I would not anticipate that most people are going to be buying a quantum computer and incorporating it into their business. I think the bigger issue with quantum is more at a government level, where people are concerned that it'll break encryption and This is an issue for banks, of course. In fact, it's an issue for the entire internet. It's held together with encryption. HTTPS, the S, is actually at risk if quantum computing becomes real. And so my real concern with quantum isn't about how it's going to make better investment decisions, which I think is a long time away, but more about a breakthrough that occurs and then all of a sudden the internet doesn't work right for pretty much everything.
Thanks, David. Deven, Insight has invested through multiple technology cycles, from PC to smartphones. Drawing on your experience in SaaS, software as a service, what is the next for enterprise software? And will current SaaS giants successfully embed AI, or will they be overtaken by the AI native companies?
Do I get the next 25 minutes to answer that question? But first, Samson, I want to thank you for having me here, and thank you for the long HKMA partnership. We do really appreciate it. I think if you think about these transitions and you think about mainframe to client server, and then client server to SaaS, and then SaaS to mobile, and then kind of AI, what you've seen in every one of those transitions, which is not surprising, is that some incumbents won in those transitions, and many incumbents lost, and new entrants came in. Salesforce would be an example of somebody who Siegel owned that market and should have continued to own that market, but Salesforce disrupted it by being a cloud solution early. And so I'd anticipate that you're going to see the same thing here. But I think that the way I would try to contextualize it is think about what are the companies that have the highest risk of disruption, or what are the characteristics of the incumbents at the highest risk of disruption. And what I would say is if you think about software very broadly defined, you have horizontal software. That's relevant in any industry. I mean, Salesforce would be an example of that. HKMA can use it, a manufacturing company can use it, Insight can use it, but we all use it a very different way. And there's not the business process or data is not necessarily for our industry. And so we kind of customize it for our own use. And so if you talk to lots of customers, they would say, well, Salesforce is fine, but it's not great for me. Well, that has the highest risk of AI disruption, because you can now get two very talented coders and at very low cost build something that's purpose-built for you. And so I think if you're an incumbent and you're a horizontal application, you really need to think about how are you going to make your application either more relevant for specific industries, or you're a system of record, which is Salesforce mode right now. All of the 250,000 companies in the Salesforce database are in a Salesforce database. And if that were not the case, my guess is we might not be using Salesforce. We might be using a system that's built for private equity, as an example. But the next point I'd make, vertical, on the other hand, has much less risk of disruption, because the business process, if in the oil and gas industry or in a manufacturing industry, and you've built those business processes into your software, and you're integrating into back-end systems, and you're getting access to that data, that has less risk of disruption. And then the last point I'll make, so not to take up too much time, is that if you think about prior shifts, so when you went from client server to, went from mainframe to client server, or client server to SaaS, you were still just replacing software. You're taking one software and you're replacing it with a different software. Maybe you had a better delivery mechanism, you had updates that were more efficient, but now you're going after something different. You're going after labor cost as well. So the addressable market in a vertical software market is much, much larger when you're not just solving for software, but you're also solving for labor. So you're going in now and saying, Mr. LP, here's your portfolio risk management software. We're going to deliver it in the cloud. And oh, by the way, because it's AI native, there's 7 people you don't need anymore, right? And so the TAM for these vertical markets, whether you're an incumbent or not, is much larger because you're solving for a bigger cost play than you were historically.
Thanks, Deven. Richard, you have described AI as new flowers blooming on black soil, framing it as a core capability, not just a feature. Beyond providing capital, how do you see the private equity value creation playbook evolves in the AI era? Specifically, how are you helping portfolio companies to leverage AI?
Wow, that's a question challenge for all the, the fund manager in the early stage VC, especially in the AI. So I think, a lot of things still keep on changing. So how to create the value as the normal VC, but do want to focus on the what is AI bring difference compared with the other innovation cycle. Usually, the innovation first come the science breakthrough, and gradually you move the more focus on the engineering efforts. That will be the stage for the VC and the startup company focus on. But AI, for this, the innovation cycle, I think the key difference that, for example, like OpenAI or a lot of, foundation model company, the way they manage the innovation is that they consolidated the science or research plus the engineering. So that's very challenging for all those, the startup company and also for the VC, how to really identify the value and how to evaluate them. So that would be basically push us, how to give the question how we can relevance to the AI and capable to evaluate that, and also identify the, the good entrepreneur. So the way for us is that first, if we really want to be, be relevant to this, the innovation, we need to be more access to the science, the scientist or research, the networking. So that's very important. And also how to evaluate the SOTA of those, the company. We need also bring some, the brand power from the outside. And also internally, we have to be more like, the research firm, not just the investment firm. So the knowledge management capability for all the VC and the PE firm is very crucial right now. So that's a lot of challenge for this industry. So our solution is that, just to very quickly adapt to this, the new paradigm shift, and also make networking and make friends with those, research. But also don't just follow the trap that, entrepreneur, there's so many, the entrepreneurs, they are science or the research background. That's the trap. If they don't have the engineering capability, the science or the research cannot convert to the real, the product. That's also the challenge for all the, the sectors. So for us, how to, to create value, there's several things. I just mentioned those are the challenges, not for the VC, but also the entrepreneur. The other thing is that, any entrepreneur is older than 30 years, probably you are not, the AI native entrepreneur. So that means all the entrepreneurs in the AI native things, innovation, they're very young. You have to take the risk. So how to be neutralized or, the coach those young people, that's very challenging. Because, and also another thing is, the technology evolves so quickly. Every quarter there will be something new. So you have to identify those, the entrepreneurs who are fast learner, very quickly adapt. And the last thing I want to say, for AI, I don't think this is the internet in China, innovation is more domestic, the demand. But right now, I think by nature, AI is global. So you have to identify entrepreneurs who have the global, the adaptivity as well. So that's a lot of things we can do, value add and value creation for ourselves, but also value added to the entrepreneur as well.
Thanks, Richard. So I should forget about a career in AI or starting my own company, staying at HKMA. Today, AI and high valuation multiples go hand in hand. Deven, you have noted it's been exceptionally difficult to find interesting things to invest in because of valuation. I think you have made that comment before. Do you believe
I might have made it to you yesterday.
Do you believe we are in an AI valuation bubble similar to the dot-com era? Or are there fundamental differences? How does this shape your current investment approach?
So I think absolutely we are seeing elements of a bubble in AI valuations. The challenge is, so one, let's first start by talking about what's a positive of a bubble. And unfortunately, it's not an investment comment. The positive of a bubble, and this is true in the telco industry, this is true in the internet, is companies are able to raise unlimited amounts of capital at very low cost of capital and build a lot of infrastructure. For the next 20 years, that's a good thing, right? Meaning we're going to have plenty of data center capacity. We're probably going to have, maybe we'll get creative about energy in ways that we historically have not been because the demand is needing to grow really fast. for a 20-year cycle, that's a great thing. And bubbles allow these bursts of investment to let you do that. So as a country, as a world, that's probably not a bad thing. As a fiduciary for HKMA's capital, it's not necessarily a good thing. So we need to understand the positives of that capital, but at the same time, mitigate the risk as an investor, right? And so how are we doing that? And I can only speak for ourselves. One, we're investing way slower than we were in 2021, right? So, we've raised a fund a year ago now, as you know, and we're only 25% invested. It would be very easy to be 75% invested. The second thing is other way we're risk mitigating is by writing smaller checks in very high growth companies where we can double down if it's working, right? Now the valuations for those companies are still high, but we're taking much smaller bets than we normally would, and then really doubling down on the winners. And I think you do, to my earlier point, have to think about the addressable markets of these companies very differently, right? And that is a big difference from the prior boom. You also did have in the 99-2000 time period, many companies that were raising money that had no revenue. And while there's some examples of that, we were talking about that earlier, by and large, that's not true of the companies. And then the last point I'll make, what is true is these are unprecedented growth rates, but they're also unprecedented burn rates, right? So if you look at, OpenAI, and I'm just using numbers that they've publicly disclosed, I think it's probably a $14 billion revenue company, but they've done $1.3 trillion of forward commitments, basically to get capacity for compute, right? They've also forecasted $100 billion of revenues by 2027. The hard thing, and the question that somebody would ask me when you're underwriting is, well, what's the long-term margin? And I can't really answer that question right now. What is true is that the cost of buying AI tokens is going down dramatically. And what is that doing? It's dramatically increasing usage, right? To use a consumer analogy, we looked at Uber early on and we totally missed it. We missed it because we looked at it and we said, well, it's New York and San Francisco, it's a $300 million cab market, how can this ever be big? And they ended up doing UberX. What was that? It was just reducing the price point, making it more accessible, and demand significantly increased. So I think we're seeing the demand significantly increase. And then the question, which I don't have the answer to, is at what point is the value of what you can do so high that people are willing to pay a very, very large premium for it? We're not at that point yet, because the average ChatGPT user is a free user. Then you've got some subs that are $20 a month, and you got me at $200 a month. You don't have a lot of people above that, right? But if we can do some of the things that we think is possible in science and other areas over time, the company should be able to extract more value. But anyway, I think I answered your question as to how we're mitigating our risk with respect to insight.
Thank you. David, I saw you smiling and nodding. This is an important question. Do you have anything to add?
I agree. I would add one risk that people should consider is that many AI investments are actually quite correlated. It's really investing in the same thing, and meaning that many of the AI infrastructure plays, the data centers, the people developing the LLMs and the cloud providers and so forth are, many people have now pointed this out, they have a lot of company investment relationships, and they're all essentially relying on the same sort of growth that you were describing. And then there's another class of AI investments that are more, I'd say, in the application space that are not part of that correlated bet on, essentially infrastructure. And so, I would worry more about, the correlation issue here, and look more for things that are not part of that, essentially same trade.
Thanks. So now we'll zoom out a little bit, and this one may get interesting. So David, I'll stay with you. We are seeing divergence in the global AI ecosystem, largely open source in China versus more closed source in the US. How does this difference in model accessibility shape the development of commercial use cases and business models?
Well, this is I think, a really very fundamental question for understanding the industry, and I can't really answer it, but I can point out perhaps ways to think about it. People that are making closed source systems like OpenAI have the advantage that they can essentially perfect the product, make improvements to it, and pass it on to everyone using it. And that's a very scalable approach. And they can apply vast amounts of money to perfecting the product and improving it. The open source models at the moment don't have that advantage. And in benchmarking, they don't perform as well as, for example, the best that OpenAI has, although the gaps are surprisingly not necessarily as large as you might think. Now, this is still the early days. If you go forward 5 years from now, one possible scenario is that there will be a great equalization of ideas and technologies, and there won't be that much of a difference between sort of the open source stuff and the closed source stuff. In the software industry in general, if that's to be a trend, Linux is most people believe better for pretty much everything, which it's open source, than the closed source stuff that Microsoft has. And but in the earlier days, closed source computing, the IBM era and so forth, had better software. And so I tend to think that if you look at the way that the technology world has played out, open source has played a big role because it allows forms of collaboration that you wouldn't get if you have a closed ecosystem. Okay, so I don't know what the answer will be, but I wouldn't bet against open source. The other comment I'll make is that, and people do talk about this, if you're betting your entire business on a closed source solution provided by a company, what happens when they change it? That will impact the outcomes that you're getting from an LLM. So some people may feel that their business will have far more predictability. Once they have something that's perfected and working, they don't have to worry about it changing underneath them. Finally, I'll say that this is inevitable. Over probably a small number of years, all the ideas for LLMs are going to converge, as I said a moment ago. And then what comes next? People building specialized models that are tailored directly to their applications. One of the difficulties with the closed source approach is they're working on general solutions that everyone can use. And it's not really easy to come up with, at least with today's technology, an LLM that's good at everything. And so ultimately you may have a fragmentation where there are different models that are much more applicable to certain kinds of problems. I don't want to keep going here, but my final point will be AI is not just one thing. And one of the best scientific examples of AI is AlphaFold, the protein folding problem, and that is not an LLM. That's a purpose-built system using many different kind of AI components to solve the protein folding problem. I would expect to see more of these purpose-built systems for different applications in science and industry.
Thanks, David. Deven, you have something to add?
Yeah, I mean, I probably don't view the open source as a significant. I think the LLMs have significant risks in their business model. There's no doubt about that. I think we hit some of them. Open source is not keeping me up at night as a risk. I think that the few reasons for that, one, if you think about open source models versus open source software, really here what you're really doing is you're kind of opening your weights up, or kind of the underlying weights of the model. You don't really have a big community of people who are making tons of changes to the actual model. That's like number one. Number two, I don't think this is where companies wake up in the morning and feel like they have an edge. If you talk to Fortune 50, Fortune 500 CIOs, and you say to them, let me have a meeting with you, tell me how you tune an open source model to customize it for you. I mean, they're still trying to figure out how to implement AI. Tuning a model is way beyond what they're thinking about. And I believe that that dependency, as these Anthropic is already selling to 80% of the Fortune 500. So I'm not saying that open source is going to have no share, but I think there's a lot bigger risks for the LLM models than open source.
I think it's still, I agree with what you said. It's still the early days, though.
I was trying to disagree, but.
Yeah, no, but I agree, though. But I would only add to that that it's still the early days. We're only a couple of years into this. And so when I'm looking out more, I don't think it's a risk tomorrow, but 5, 10 years from now, I see a different kind of possibility of a different kind of convergence.
Richard, you want to say something?
Yeah, I think probably I have two comments. One is from the industry perspective, the other from China perspective. So for the industry perspective, I think normally, if you look back about the history of the computer industry, IBM used to be just advancing for the whole industry for many years, and it's typically the closed source, the model. And IBM claimed we only need 5 IBM machines. We can solve all the problems for the whole world. That's early days. But I think open source today have more like a thinking pattern like IBM. It makes a lot of sense because they are the most advanced, the model, and they can deliver everything for the full stack of and also the business model. They can generate revenue directly, and they sell premium. But I mean, always the computer industry, you always have the closed source and the open source. But open source usually means that much more booming of the application in all the the different diversified applications. So that's my one comment. The second comment from China's perspective, China always played the role that US is deliver the 0 to 1 most advanced breakthrough innovation. But China is the faster follow and more capable to transform from the breakthrough into the application more quickly and in large more scale. I think at this time it's very similarly. You can see DeepSeek and other open source the player from China. They play the same pattern, like they can very quickly deliver the similar performance of like the OpenAI, but with disruption, the innovation to deliver the much lower cost. So the open source, I think that's probably the smart way for Chinese company. If they cannot deliver the same advanced performance like peers in the US, the smart strategy, they can deliver the cost advantage, but with similar performance. So that's from the competition perspective.
The one other point I'd make, and David made the comment earlier on quantum as it relates to security. I think this is an issue with the open source models as well. These models are also much smaller. And as you kind of think about risks and threats of the wrong people using these models for wrong applications, that's just something that I think governments are spending a lot of time thinking about. That's not a comment about the investability of it. It's just something that I think we need to be cognizant of.
Yeah. Let me finish. The last point is that, in terms of the open source for China, is that, we have large population, 1.4 billion population. Usually means that you have more diversified use cases. And also you means that large data. And the closed source strategy that, OpenAI want to sell the token to you. But it will give you less capability to leverage your data. The open source, the approach will give more space for the developed community. They can leverage their proprietary data, and leverage that data to create more value. So I don't think it's simple yes or no, it's good or bad. But I mean, this basically from China perspective, open source is a smart way to try to compete in this market.
I do want to ask one more question, but David, I'll let you have the last word on this.
I was just going to add that, as you can see, this is a hotly debated topic. I think it's actually a pretty key question as to how the models, the foundation models as it's called, evolve. And I think it is not a settled question. I think many people believe that, it's all been worked out. There are going to be a couple of companies that will have the very best models. Everyone's going to use them. That very well could be the case, but I think it is not anywhere near a settled question.
Thank you. So here's my last question. Tech giants are pouring unprecedented amount of capital into AI infrastructure. We are talking about trillions of capex over the next few years. And this is something our speakers also mentioned a lot about yesterday. Deven, from the perspective of return on investment, What is your view on this AI investment wave, and how do you guide your portfolio company on AI investments?
Yeah, look, so we're not investing at the infrastructure layer, right? So we're not investing in kind of the data centers or the things that have the high capital intensity. So the vast majority of our portfolios are not really spending money on CapEx. They're spending money on R&D to add to the application layer. But to the broader question, I think what we have is, if you look at the projections for the OpenAIs and the Anthropics, and they've publicly talked about numbers in the last couple of years, in the last couple of days, just between those two companies, they're projecting close to $200 billion of revenues 3 or 4 years out. So the interesting thing is that you could probably just from the revenue and gross margins of that revenue support the CapEx spend. However, at some point, you actually need a profit pool beyond being able to spend money on CapEx, right? And that's the question. And I don't know that I have the answer for that. Anthropic also said they're going to project significant profitability in 2028. I hope that's true. But I think that I do think there's a scenario. I think the question really is, how quickly can we absorb all this capacity? And the one thing we were talking about earlier, which we didn't really get into on this panel, but I'll just make the point that we all kind of talked about, is you're increasingly seeing these large companies do these data centers off balance sheet, right? Facebook, for example, just did off balance sheet. These are all AAA companies that can raise money at the lowest rates of any company in the country, but they're raising money at 9 and 10, 11% off balance sheet because they don't want them on their balance sheet, right? Why is that? Well, they don't want to have that leverage on their balance sheet. Like, that's sometimes a sign that there's a risk to the amount of capacity that's being added and the speed at which is adding. So I think it's just something we have to continue to look at. You have to monitor the rate of growth. And if you see, I think what would stop this bubble, right? Like if all of a sudden Sam Altman came out tomorrow and said, "Oh, sorry, I didn't mean 100 billion, I meant 50 billion." That's where you'd worry, because that would just suggest that the rate of absorption of this data center capacity is not keeping, the revenue is not keeping up. Right now it is, and the last point I'll make, which was talked extensively about yesterday, and I'm not an expert on, but energy, right? Satya Nadella made the point 2 days ago that his problem right now is not accessing chips, right, which is really interesting if you're NVIDIA. It's that I can't get enough energy into my data centers to plug those chips in, right? So I think that what this is also going to drive is a massive, and I think this is a positive, I said earlier, a massive amount of innovation in energy. For the first time, the US is looking at nuclear again. It probably makes sense to have looked at nuclear, and it's amazing that it took ChatGPT to get the US back into nuclear energy. We'll end on that note. I'll end on that note, sorry.
David, you have anything to add on this one, or?
No, the real challenge, I think, in the next couple of years is going to be, right now I think we're in a period where everyone is experimenting with the technology in their businesses, and that's fantastic. The availability of technology to try things out is now quite widespread. So you can't find anyone who's going to say, I'm not testing AI at my business, and which is fantastic. And this is an incredible experiment. We're going to know better in a couple of years how well these experiments go. And I think that that is going to be something I'll be looking at really carefully. Are people truly getting productivity gains? Are they truly driving new innovation in their companies? Or is this something like PowerPoint? It's nice to have. It makes certain things look more beautiful, but fundamentally it didn't transform the business. This, to me, I think is the biggest question.
Well, I want to thank my panelists for the very lively discussions, and can we give them a round of applause, please? Thank you.